Thank you so much, and it's really a pleasure to be here. I think, both the panelists who spoke prior to me have undoubtedly brought out the importance and the imperative that really holds in terms of the implementation of the Sustainable Development Goals. And to my mind, banks play a very central role in an economy as they infuse capital. Therefore, they have to be extremely mindful of their actions as well as their strategies, and more bringing in climate and sustainable development agenda from really the periphery to the mainstream. I think that is what is required across the world, more so in India. Well, since yesterday, you may have heard about how emerging economies like India have picked up the momentum with governments, policymakers, regulators. We heard NSC speak about certain mandates that have come out, which are really working, and it's like picking up a momentum towards achieving the global goals. However, there's much needs to be done, given that, and by all actors, not just the governments or not just the regulators, but also the private sector, given the quantum of the finance that is required for India to achieve just its nationally determined contributions, which are in the tune of 2.5 trillion, which dovetail as a objective which is inherent within the SDGs. So just let's look at what is this quantum of challenge that we are looking at. So over the next 5 years, India would face the world's largest financing problem, and that is including millions into the financial system towards financial inclusion to ensure access to financial services across. And this really dovetails into the SDG 1, which would address poverty. Bringing affordable and reliable supplies of clean water and energy to all of its 1.3 billion inhabitants in line with SDG 6. Investing in enterprises that will provide livelihoods for for an extra 10 to 12 million job seekers each year. And given that 35% of the Indian population is youth, I think this is a very big challenge that we are currently facing. Building smart cities to ensure safe and resilient living spaces, investing in sustainable agriculture, given the agrarian nature of the Indian economy. And apart from these capital-intensive targets, India is steadfast on its ambitious commitment of generating 175 gigawatts of renewable energy, a target that the government has taken by 2022. Just the solar target, which is 100 gigawatts, would need additional 100 billion US dollars, apart from the huge financial requirements that are there on the table. So therefore, financial flows in particular would now need to be more aligned to really long-term sustainable development objectives. And that would require determination, imagination, discipline, and cooperation between public and private sector, bilateral and multilateral, and all the sources, impact investors and the communities who would bring finance to the table. For banks, if you look at the regulation, 40% of the balance sheet is to be committed to a priority sector lending. That's the regulation. And the priority sector lending goes out to farmers, women-owned businesses, MSMEs. So there is a regulation here where banks channelize 40% of their balance sheet. But finance still remains a key challenge in moving SDGs from ambition to reality in India. Along with the government's push on the policy front, mobilizing new sources of investment like green bonds, we heard her speak about it, credit enhancements, and blended finance would really be the key interventions that would alter the trajectory to SDGs. You may have heard about the recently launched Principles for Positive Impact Finance by the UNEP-FI, the United Nations Environment Programme Finance Initiative, and Yes Bank has been part of this group driving it. It provides guidance for financiers and investors to analyze, monitor, and disclose the social, environment, and economic impacts of the financial products and services that they deliver. These principles can give the sector a collaborative, solution-building approach to develop and implement new business models and financing approaches that will really help address the SDG funding gap and realize the SDGs themselves. So we have been at Yes Bank using all these kind of tools to be able to stay ahead of the curve. So Yes Bank is India's 5th largest private sector bank Currently, we are in the 13th year of our operation, so we are very young in terms of our vintage. And we've really adopted a very differentiated approach towards sustainability. The sustainability framework for us is very well integrated with the bank's business strategy, thus ensuring long-term business success by contributing to economic and social development, a healthy environment, and a stable society. That's very embedded at the core of the bank. With a 360-degree approach, there are really 5 areas that we look at. One is integrating ESG into lending decisions. This is extremely important from the risk mitigation standpoint, and ESG is very well embedded as a robust framework in our entire lending. And for that, I believe institutions have to understand the risks and understand the sector very well. So in 2005, when the renewable energy sector was just picking up, Yes Bank, given our knowledge in that sector, was one of the early investors behind renewable energy. The second is on making investments, responsible investments into those sectors that are either focusing on SDGs or those which create positive impact on ground. And that is the sunrise sectors that are coming up in India: affordable housing, water, sustainable agriculture. I think these are, and they form a part of our portfolio. The third, which is extremely important, and I'm going to highlight that in more detail, is, since the session is on financial innovations, is innovating for the bottom of the pyramid. There is a huge opportunity and a huge gap, underbanked and unbanked, at the bottom of the pyramid, and banks have to really look at innovations, financial innovations, that not only make the impact, but also are delivering on an overall financial ROI, because financial institutions would only look at if there is a return on investment, and this correlation has to be drawn really well. Greening of our core operations, we are the only bank in the world to be ISO 14001:2015 certified, and we look at our own operations as a part of our own carbon footprint measurement. And I think the fifth area, which is very important for us, is there is a law in India where there are companies above a certain threshold which are to commit 2% of their 3 years average profit before tax towards corporate social responsibility and report on it. So we look at CSR very differently. We want to use CSR as pilots to create new mechanisms for showcasing instruments like blended finance, and I'll take an example of how we are working on this. Fintech has exploded in India, that is financial technologies has exploded in India over the last 2 years, and with an expected growth of, I'm sorry, I think okay. I'm again, with an expected growth of, with an expected growth of about 20%, the opportunity for banks to leverage this major intervention in frugal payment spaces to really provide the last mile connect. India is a large country, so the reach is extremely important. Demonetization in India has been another disruptive step, which has brought digital technology to the core of the Indian economy. So for example, the mobile phone penetration in India is about 75%, with over 900 million connections. And of these, there is only about 200 million smartphones that exist, which have apps for various financial services. In order to cater to this large strata, a 700 million target market out there, Yes Bank worked with a Taiwanese company, and we innovated on a thin, slim sleeve enabled for mobile payments. So this particular SIM sleeve gets into your phone, and it ensures secure mobile payments without internet, allows payments to any mobile phone with no SIM card or network restrictions of any kind, and that too at a transaction of a cost of less than 2 cents, thus making life simply easier for those without smartphones, creating, again, as I said, a target market of 7 million. I think what we've seen is, in a family of 5, the accessibility of a smartphone is normally with the head of the family, which is a man, and the women there are they don't have phones, or they don't have a smartphone for sure in that community. So this works very well, and we have a lot of women customers who are banking with us. So I think that's a very important point from a gender equality standpoint. When I say innovating for the bottom of the pyramid, I'm sorry, do you need that up? Innovating for the bottom of the pyramid, there is again another significant challenge that we saw, which was with migrant workers who live in cities of India, and because of regulatory norms, they were not able to transfer money back home to their families with ease. So there were public sector banks that would open counters for these kind of migrant transactions for about 2 hours every day. And the laborer would have to miss work to stand in these huge lines to be able to transfer money back home. The transfers would happen anywhere between 10 to 15 days because there would be the same bank on both sides. We said it's a challenge and we need to really address the myth of going to a bank, and this was 5 years back. Well, today we don't really go to the bank, but for laborers at that bottom of the pyramid, they do go to the bank to a counter, and we said this is a myth that we need to address. So what did we do? We innovated on an existing business franchise. So in India, banks are allowed to have small agents to do small transactions under $100. And we actually worked with neighborhood mom and pop stores that can initiate a remittance on a handheld device, and the money today lands in the destination account within 4 seconds of any bank that is there on the other side. So it need not be the same bank on the other side. Through this model, we brought the transaction touch point closer to the customer, and in this case, a bottom of the pyramid laborer, even at non-banking hours, because these mom and pop stores start at 7 in the morning and close at 11 in the night. So while the priority was on financial inclusion, what we saw was a strategic commercial innovation, which has resulted in 41 million transactions for this year, 15 million man-hours saved for the economy because that laborer doesn't send his child to stand in those lines, nor does he have to stand there, and he really goes to work because he can do this transaction later. 4 million customers availing this service, over $2.4 billion remitted this year. 50,000 branches of 80 banks have been receiving these remittances on the other side. 48,000 mom and pop stores today are a part of this entire franchise for the bank, and it's a livelihood enhancement for them because they earn a transaction fee, which is very small. The fee that is charged for this transaction is far less than what even the post office offers in India. 51% repeat users every month, and 52% transactions beyond banking hours, which is simply giving accessibility for the families of those laborers who are working in cities with families in the villages. So I think these are the kind of innovations that we are looking at, and going further, developing innovative financial instruments that provide investment direction for not just climate action, but for all environmental, natural capital, water, land use objectives that are really embedded within the SDGs is very crucial for India. So green bonds have emerged as a priority finance mechanism or a quasi-financial instrument for driving global economy's transition into a greener future. Green bonds market is pegged over $200 billion cumulative issuances across emerging economies so far. In India, given the regulatory reforms, Yes Bank really took that plunge and built an ability through understanding risks. We issued India's first green bond in 2015, raising $160 million, and this was in line with Yes Bank's COP21 commitments of mobilizing $5 billion towards climate action. The issuance has been a big success, which has led to a kind of a market momentum where others have followed us. SEBI, the Securities Exchange Board of India, brought in disclosure guidelines and issuance requirements. So there's a market standard that has got created, giving a level playing field to issuers. And following Yes Bank's successful issue, IFC raised $50 million on the London Stock Exchange as a part of their green masala bond program. Now, the innovation here really was that a AAA rated agency like IFC was able to source capital from mainstream investors and send it through to an emerging economy through a yes bank. And that was, I think, the beauty of the modeling of this entire transaction that was done. The third bond that we raised was recently in September 2016 with FMO of Netherlands, which was FMO's first ever investment in green bond issued by a bank in India. This was, again, a $50 million bond. So the benefits of the Yes Bank's green bond market involvement were multifold, resulting in both internal and external movement within India. So following Yes Bank's first issuance, we saw 13 other issuances, creating a kind of a market towards green finance. But what we've seen is, across the world, also in India, green bonds are really targeted towards renewable energy, energy efficiency, so on and so forth. And we really want to move forward to look at water bonds or look at bonds that are socially inclined bonds. I think this is something that really needs to be created from an SDG addressing standpoint. And my final point on CSR that I really want to say here is, I believe that, with SDGs and the kind of financing that is really required, development banks have a large opportunity here to play a differentiated role in terms of credit enhancements for blended finance. So to be able to demonstrate a model, what did we do is, we looked at, in the western part of India, in Gujarat, there is salt farming that happens, and there are women which are majorly involved in the salt farming. There are about 38,000 women salt farmers who do this activity from September to April every year, taking advantage of the sunlight. And they are in an unorganized sector. So obviously they are borrowing money from money lenders who are at almost about 100%, anywhere between, up to 100% rate of interest. And that was the huge input cost that was going into this entire production of salt. One of the, and these are destitute women where their income, after the activity from September to April, their income is not more than $500. So they are really, really in need of, really destitute in that sense. The biggest input cost was they run diesel pumps to be able to extract brine from the ground and make salt from it. So what did we do? We worked with a local bank to look at a blended finance model, and here we used the CSR dollars that the bank had to create credit enhancements. So we said that we will replace the diesel pumps with solar pumps, because then the input cost goes down drastically. They don't have to buy diesel. It's also good for the environment. And those were on the back of loans that were given by the local bank. The local bank obviously will not want to take a risk, so hedging the risk is what we did. We provided credit enhancement, and on the back of this credit enhancement, 600 women have got loans. Then there was an affordability criteria, because the local bank's rate of interest was 13.5%. And we assessed that these women could pay about 5.5% kind of an interest. So from a credit affordability standpoint, we said we will intervene and we will do an interest subvention of 8%. That's another thing that we did. And the third was overall capacity building, because it's important to train them on those solar pumps to be able to maintain these pumps, which was important. So this is a kind of a blended finance facility that we have brought about. What we are seeing is that they're healthier, because they don't have to, running the diesel pumps is a strenuous task. Their income levels are going up. On the other side of the value chain, we've got large industrial salt buyers to be able to do these deals with the women. So they're earning more. So where they were actually getting about 150 rupees per quintal for the salt, they're today getting about 420 rupees a quintal. So that's really a livelihood enhancement. And what is it that we are demonstrating? We are demonstrating here really is that Yes Bank wants to play the role of a local bank, or banks need to play the role of the local bank. And we want developmental institutions, multilaterals to really come with these kind of credit enhancements, credit affordabilities, or the capacity building. So that is really the emerging role in developing economies that we would really want developing banks to pay. So these are the kind of pilots that we put out using very innovatively the CSR opportunity that we have here to demonstrate how the bank can really concentrate on SDG financing. Thank you.